Good afternoon. On behalf of the American Bankers Association, I would like to thank you all for attending today's webinar, Unlock Predictive Risk Insights with Predict360 plus Fred and Pierre Metrics. My name is Justin Gall, and I work in the Endorsed Solutions Group here at the ABA. We are very excited to be hosting this webinar with our endorsed partner, 360 Factors. The ABA endorses 360 Factors for their compliance management software. 360 Factors Predict360 Compliance Management Solution is a next-generation, cloud-based, highly integrated software solution for managing governance, risk, and compliance across an organization using a single integrated platform. Predict360 incorporates artificial intelligence and natural language processing technology to help banks automate and reduce the effort involved in managing ever-changing regulatory compliance requirements. It is easy to use, quick to deploy, and has a low total cost of ownership to help reduce clients' efforts in managing their compliance and regulatory requirements. Now it is my pleasure to introduce today's presenters. Our first presenter is Kenneth Proctor, a director at 360 Factors. During his 40-year-plus professional banking consulting career, Kenneth Proctor has served as an internal consultant with a major regional bank, held responsible management positions in the auditing departments of 2 Southeastern regional commercial banks. He is a certified public accountant, certified bank auditor, and a certified enterprise risk professional. Ken is a frequent speaker for financial institution industry conferences and seminars, including those sponsored by the American Bankers Association. In addition, he has delivered workshops and presentations on risk management, technology risk, and other topics for numerous state and community banking associations and international banking associations. Our next presenter is Robert Berger, Senior Vice President at 360 Factors. Robert brings over 20 years of technical sales and people management experience to the organization. Robert is focused on building an industry-leading organization founded on a culture of customer success, integrity, continuous improvement, and enjoying each moment, as well as developing a customer-centric and thought leadership-based consultative approach to 360 Factors customers. Before I hand it off to the presenters, I want the audience to know that the webinar is being recorded, and links to the recording and slides will be emailed to all attendees following this presentation. So now I hand it off to Robert.
Thank you so much, Justin. It's a pleasure always to get a chance to collaborate with you. I want to welcome Ken Proctor, also known as Professor Ken, given his tenure at the Southwest School of Graduate Banking. This is going to be a fun topic today, so we're going to have a lot of fun. I am going to kill my video, but it's always nice to say hello to everybody and welcome you to the webinar. Just for bandwidth, I am actually working remotely today, so again, just want to welcome everybody to the webinar. We've got a lot to unpack today. So how can we all get the most out of today's webinar? Very similar to how we've done it in the past. We want to have fun. So Ken and I are going to have a little bit of back and forth, try to make it as light and anecdotal on the concepts, walk through a few things that everybody here on the webinar may have seen. There's been a lot in the news recently, so we're gonna walk through some different scenarios. We would love for y'all to interact with us. Please feel free to submit questions. We have our team that's going to be looking at those questions, and time dependent, we'll spend a little bit of time at the end of the webinar to cover a few of those. Feel free to chat directly to us as well. We'll be monitoring that. And then last but not least is follow-up. So there's a few different ways to follow up and some really phenomenal resources. Justin's already mentioned the recording and the slides. There's going to be some pretty cool scenario analysis that is going to be part of the presentation today. There's also some screenshots of what you're going to be able to see today that you can reference. And then we're going to talk through a few resources that the American Bankers Association has put out that have been extremely useful to understand what some of your peers are doing with regard to the state of risk and compliance in this industry, in the banking industry specifically. So please follow up with us. We're always glad to have a follow-up conversation. Again, this is a 1-hour conversation with a lot to cover in a short amount of time and a very broad audience. We recognize that any one of you may want to have a more intimate conversation that's very specific to a scenario. We're always glad to address that as well. So jumping right into it, what is today about? Well, we're hearing a lot around the topic of risk management and risk reporting and how that can really bridge the gap where there might be some missing pieces or missing information and accelerate missed opportunities. These opportunities could be more than just loss mitigation. So obviously you can miss an opportunity and step in the wrong area or do something that costs your organization reputational points. It may cost you actual money. It may cost you operational control as you're under some strict orders to perform some specific tasks. But more importantly, it might cost you innovation and revenue opportunities. So how can you start to understand the negative consequences of overlooked information? And kind of compound that, not just overlooked information, but the right information. There's so much information that's at our fingertips today. How do you start to hone that and focus it in the way that's most applicable for your organization? So to kind of touch on that, as a phenomenal resource that I know that the American Bankers Association has put out, research study. They worked with 250 bankers that are really trying to meet today's challenges and opportunities across risk and compliance. But these are CEOs, CFOs, chief risk officers that are trying to perceive gaps in risk data. And really, what are they wanting to, where are they at today, and what are they wanting to do about it? Where do they believe the gaps are, and where there could be some easy wins for innovation in this space? So we'll spend just a couple minutes on this, just because there are some pretty salient points that came out of this report as far as risk reporting goes. I know that's the topic of today, but really set in the context of why this is important. You've got executive level titles that are identifying gaps in existing risk and compliance data and reports. So where are these gaps? We'll touch on a few of these here that are highlighted and actually show you some examples of that throughout the conversation today. But just a few comments. I'll start with the first one. Ken, financial performance not tied to risk and controls. What are your thoughts there?
Not tied to risks and controls. Unfortunately, we spend an awful lot of time, I think, focused on, they always go nuts when I say the deck chairs on the Titanic, but we spend a lot of time focused on risks and controls and the risk statements and control statements and doing risk assessments, and not necessarily tying those to financial performance, particularly the bank's internal performance and external economic data, market data that tends to impact financial performance. So again, I think there's a significant gap there. So yeah, you're right to be worried about financial performance indicators, not just your internal ones, but how do your internal ones match, or how are they influenced by external economic data? And so that's why we're tying in things like FRED data and other external data sources. And you'll hear that theme throughout the webinar today. Yeah,
if your own risks and controls that you're looking at internally are siloed and simply a check the box activity, it's not giving you a real idea of where the connection is to your strategic objectives. The next two are big ones for me, and I see them all the time. Peer performance, and Ken already mentioned too few metrics from those external sources, such as market conditions. If you have a good idea, if you can tie those financial performance indicators to your risk and controls and assessments and understand really how well we're doing, well, that's one perspective. Now, how do you compare that to your peers and to external market conditions? At the end of the day, like if we say we set a growth path of 5% growth, and we hit that right on the head, we did a really good job of doing that, but all of our competitors hit 15 or 20% growth. What does that mean to us? And it may still be fine. It may still be exactly where we want to be because we're less risk averse. We're more risk averse, and we don't want to necessarily extend our. But it could mean we're falling behind in a market that is very open for us to be able to drive more revenue, or in fact add different products or services or new innovative areas for our members or customers or whoever we're working with. So those are two big areas. The second two metrics are not benchmarked for peer performance, and the data's out there, right? You got FFIC call report, you've got metrics from market conditions, and that's you already mentioned FRED. You got CoStar, you got other types of areas where you can get some phenomenal data to help you understand where you're sitting and what does your internal data mean in context to where you're looking at. This next one, Ken, I'd love your thoughts here. On the risk appetite side of it, please tell me your thoughts there.
I think we give management teams, management committees, and boards of directors a lot of data, and sometimes not a lot of actionable information that they can rather quickly grasp. So things like charts, graphs, comparisons of things over time to timelines, multiple things tied together on charts like, where are we in relation to our risk appetite? At the same time, where are we in relation to our peers, regulatory limits? Let's take a look at all of those things together. And if we are the outlier, if everybody else is moving to the left and we're moving to the right, what is it they know that we don't know? Are we just that much smarter than everybody else? But perhaps not. So the data visualizations help directors in particular get a pretty good grip on the bank's risk position, much better than a bunch of data on, sort of the dense reports we tend to give directors.
Absolutely. And both your risk appetite tolerance and your regulatory limits, which are tied together in most cases, or ideally are, right? Those should help really guide when are you starting to get in trouble. Those visualizations and gosh, should make it jump off of a chart, or where is something not working like we expect it to. And if I'm having to thumb through 10 spreadsheets or a PowerPoint slide that has an anecdotal red, green, yellow, how does that help us make better decisions as an organization? So we're going to touch on each one of these today. Given that those were the top areas of feedback, how do we start to address that? How has technology advanced to support the people and processes across the organization? And it's not just a risk and compliance game. I mean, you have the entire executive staff that has responsibilities for strategic objectives, all the way down to your frontline employees who are interacting with customers and members on a day-to-day basis. Now, we started with the CEO and CFO because obviously this is getting a lot of views and a lot of input from how do I take this traditional cost center and make it more strategic in nature and really have it be an innovation revenue driver. But we're hearing it from the risk titles as well, directors of risk, chief risk officers. Now, they're very similar, that the order and the preference might be slightly different, but this first one here, if my metrics are not tied to strategic goals, how important do we feel like what we're doing? I mean, they're very similar, but it's kind of looking at it from the other direction here. These need to meet in the middle. So why does this matter at the end of the day? Well, there's a lot of risks that we may not know about that are directly related to how we are operating the organization. And there's also a lot of opportunities that may be hidden for that unique innovation, for becoming the next best thing that's out there. So we'll cover all this. I know, Justin, you already mentioned the recording and the slides for this, but this is also, if you're an active ABA member, you have access to this report as well. This 2023 Outlook. I highly recommend taking a look at it on your own time. We're always happy to share some of the top takeaways. There's a few recordings and analysis on that, but please feel free to reach out to us. This is available for all of you ABA members that are out there. Now I'm going to slightly shift gears here, and we're going to talk through something that everybody here probably is somewhat familiar with. There might be a few people who are born in the 90s that might be on the webinar today that don't have as clear of remember this, but I've got a phenomenal resource with Ken on the line, and I know it's easy to be an armchair or a Monday morning quarterback and take a look back and always analyze and look at it. But this is a phenomenal example that sets the context for exactly what we're talking about today and where the worry and concern comes from these executive levels. So I want to start here, and we'll start with Ken. I'm going to hand it over to Ken, talking through just a brief recap. Go back 20 years. Take us back in time with your time machine, Ken.
Oh, I can do that. So I don't know if you want to move the slide forward or just cover it here, but back in the early 2000s, I had the opportunity to sit in on a number of bank strategic planning sessions, and I reviewed a lot of strategic plans. And at that point in time, they all pretty much focused on things like expanding the assets, growing assets by growing mortgage loans or growing commercial real estate loans. Everything was tended, though, to tie to residential real estate. So in my career, I've seen it happen several times that, housing takes us into a recession and housing takes us out of a recession. So it tends to go in waves. So there's a lot of conversation about, we're going to grow 15%, 20% over the next 3 years. And we're going to make, a lot of home construction loans and apartment building loans and strip shopping center loans that are near those developments. And a lot of talk about all the good things that were going to happen, and hardly any conversation about, well, gee, what happens if home prices drop pretty dramatically? What happens if mortgage loan defaults increase or housing construction declines or local unemployment rises pretty dramatically? Commercial rental rates decline or property values go down, vacancy rates go up. So not a lot of conversation of, what if we achieve everything we set out to do, but the stuff hits the fan and these things all happen, or any of these things happen. And at the end of the day, they all happened, and they all happened at the same time, pretty much.
And that's why we have so many martial arts studio and strip malls today, right?
Yeah, I found that there's three things that survive in a shopping center when the economy turns down, and that's women's nail salons. They are inelastic, they survive, and strange martial arts studios and churches that I've never heard of before.
Yeah.
All seem to thrive when everything else exits the shopping center.
And the point that I get out of this, and I love talking about this stuff with Ken, is it'd be bad if one of these things happened. It's catastrophic if all of them happen, right? But each one of these questions has a lot of variables and implications with them. And I know for me, sometimes it feels like my head's spinning. I have not had the experience in the big wheel that Ken has, where he's able to come in here and do some analysis, say, well, here's the trickle down effect. If this one piece happens, here's where you're going to see it in 2 or 3 of the other areas. One area, and we see it all the time in risk. One area of regulatory risk might affect operational risk and reputational risk at the same time. There's a lot of moving parts in dependencies. And my background is in electrical engineering, so this this type of blackboard or whiteboard here is one that I've seen quite a few times in that type of scenario. And sometimes this feels simpler than all of the scenarios that could potentially happen within the scenario that Ken just laid out. So if you ever feel like your head's spinning a little bit, it can feel pretty common because there's so much that can be going on. And when I'm pulling information from different places and I'm not connecting it together in a simple equation or being able to see one view with everything in one place, yes, it makes it a lot more complicated. So we're gonna walk through this example just a little bit more in depth. I'm gonna let Ken drive a few talking points here.
Yeah, I'm gonna go through these quickly, Robert.
That's fine. Yeah. So you just tell me when you want me to go to the next one, and I will listen to yours. But yeah, we're gonna go through these really quickly. What actually happened? Let's play it out, and then we'll loop back into what we could have done differently. So go ahead, Ken.
As I was saying, banks, a lot of the strategic plans focused on commercial real estate. So you can see in these Fed districts, San Francisco, Atlanta, Chicago, the growth in those banks that exceeded the regulatory guideline for investments or total loans, total CRE loans. So it grew as much as, out to 60% of the banks in the San Francisco region exceeded the guideline, 50% in Atlanta by June of 2006. So you can see they're all investing heavily in these types of loans, funding a lot of that growth with high rate deposits, longer term borrowed funds. So not exactly the SVB scenario, but again, betting on, fairly quick profits on commercial loans, better fee income, and funding all that with long-term Federal Home Loan Bank advances that were fixed rate. So go ahead, Rob. At the same time, there were a lot of people looking for, a lot of investors, particularly overseas investors, looking for mortgage-backed securities and investments backed by real estate loans. And so there was this drive in the market to create some fairly exotic subprime loans, things we referred to as stated income loans, better known as liar loans. If you ever saw The Big Short, you know what we're talking about. So you saw a lot of subprime loans originate in the early 2000s. And by 2005-06, they were had exploded. So a lot more people in the marketplace, a lot more people could afford a home because they could qualify for a loan under these subprime loan conditions that had balloon payments and teaser interest rates. Okay, Robert. So that led to, no surprise, a huge jump in home values. Pop it one more time, Robert. You'll see a fairly traditional trend line. If it had just kept following that trend line, it would have probably been okay. But at this point, home values went up so high that people were even taking out home equity loans to go buy another house. somewhere else. It would own 2 houses. And eventually those 3 and 5 year teaser rates expired. The balloon payments came due. Because of negative amortization, people actually owed more on their homes than they did when they originally made the loan. And so they, began to default. And once the default rate went up, then we don't need any more houses because we've got all these foreclosed houses. So housing starts plummeted. Robert? So, the flood of liquidity led to increased prices. They came back down just as quickly once the housing crisis, once the housing market collapsed and the banking crisis ensued. And you can see the trend on Case-Shiller again. There's the normal trend line. We just fell right back. All those gains we made from 2003, 4, 5, and 6, we lost in 7, 8, 9, and 10. Go ahead. So where were the failures? Well, if you remember the previous chart I showed you of the banks, the Fed districts that had banks exceeding 60% of CRE to capital, it was those states. So those guys who took too much risk were the ones who ultimately had the failures. Georgia, Florida, Illinois, California. I don't know why Florida's not on there. They usually make every banking crisis, but they missed this one. So number of failed banks. We could have, at this point in time, we weren't doing a very good job of looking at what I call leading risk indicators. We were looking at lagging risk indicators. We were more focused internally on performance data as opposed to external market data. So the theme of today is how can you use this type of data from external sources to tell you when things are turning against you, when all of those assumptions you made when you put your strategic plan together, those assumptions aren't panning out. So do you want to keep following the path that you set out on when you launch that strategic plan if all the assumptions are going against you? So back to SVB, their assumption was that the interest rate market was going to stay relatively flat. There would be no significant increases in interest rates. I don't know where they got that advice from, but pretty much everybody knew it was moving up. But that's what they did. Okay.
Yep. So yeah, really where this comes down to then is, where was the missing data? There's a lot of data there. And if you noticed in what we just showed here, there are some different formats of graphs and charts. There's data out there, but there's a couple of things that have been difficult traditionally. So I like this puzzle piece, but it also has like the little constellation connections here. There's data that we may be missing or not knowing which areas to focus on, but more importantly, how does it tie back into you as an organization? So where we see a lot of people miss is you might have a strategic objective that in certain instances, your trend following is going to be different than the individual organization across the street from you because you do business differently. But it has to be a connection in between the two. And if I have data scattered all over the place and using traditional tools like spreadsheets, it's really hard to have good connections across those to give you a holistic picture. If I think about a spreadsheet, it's a grid, right? You only have a limited number of dimensions that you can start to look at for an intercorrelation and starting to see trend analysis across different perspectives. So I'm going to start this back by just saying, one of the biggest things, and Ken and I love this concept here, but the risk appetite. One of the things that came up on that is your risk appetite aligned to strategic objectives, and then does it flow down into the forward-looking metrics and risk statements and controls that you have in place. So if you truly have an appetite that is aligned with the amount of risk that you're ready to pursue, and you are monitoring the right metrics that you have made your assumptions on, then this is going to allow you, if you're looking at it in real time, to be able to compare and understand what's happening, even as changes occur throughout a year. Now, I know a lot of organizations will look at a risk appetite either on a quarterly or even an annual basis and say, yeah, we generally like this, or this is what we're wanting to do. But then when it comes down to monitoring this in real time and understanding the implications of where things are changing at any point in time, maybe take the eyes off the wheel a little bit, or maybe you just don't have a technology that allows you to see the interconnection from strategic objectives down into your corporate risk profile and into your risk appetite, how that flows into those project initiatives that you're executing, into the metrics and where those are hitting those tolerances, so that as things start to go outside of your expectation, whether it is a risk that you're monitoring from an assessment, whether it is a metric that's a little bit outside, how do I know about it immediately so I can start investigating and taking action in a very proactive way? So Ken was so kind to show a few examples. Again, risk appetite example. This is a great example of where you might have some different categories of risk that have some strategic objectives in line with it, along with some commitments and policy guidelines. But when I take this now to a board for an hour or 2 hour meeting, and we need to make we need to have some action or make some decisions on this, where do you start? I've got paragraphs here. I've got a lot of information. I've got some target ratios that's not updated with real-time data or a trend. It may make a huge difference if I'm looking at a particular guideline and I'm just approaching that versus I'm coming down for being grossly over my policy guideline. So taking information like this and starting to understand how it's all correlated can help the executive level and actually everybody in the organization understand their role and how that helps the bank or the credit union, the financial service organization be more successful. So this is an optimized risk framework that we've seen be pretty helpful in just kind of explaining where these touch points are and where we can really start to see the correlation. Again, this can be difficult in spreadsheets and Word documents where there's paragraphs of information and it's not easy to connect different pieces of the area. But ideally, you're going to have a strategic capital plan that is going to absolutely determine what your risk appetite is. It's going to absolutely help you inform what are you trying to do as an organization? Where are you willing and what amount of growth and risk are you willing to take? So you got to start with this piece. And again, a lot of organizations will start with that at the very beginning. If not, you absolutely should be connecting those two, but also understanding, well, how do I understand in real time how well we're tracking to that strategic plan and to that risk appetite? So coming out of that, you're going to determine some risk tolerances, really understanding, here's my appetite, but where do I need to start being worried? When things don't happen like I expect them to, surprise, surprise, that actually happens. But when they start happening, when do I want to know about it? And this usually splits into two areas. And the challenge we've seen in a lot of organizations is that these can become two extremely siloed directions. One is setting my internal RCSA process on this top row. I have a risk methodology and taxonomy. This may be done very differently across the organization. My operational risk team, my financial risk team, or interest rate risk team, credit risk team may do something very different with my methodology and taxonomy than my regulatory risk team. So I'm not necessarily getting a good relative understanding. And then establishing my risks, my controls, my testing procedures, so that I have a good idea when, at least from my internal view, things are not operating as expected. But as Ken mentioned earlier, that's only a piece of the puzzle. It's a big piece and one that regulators require, but it's only one piece of the puzzle. The second one is coming down to this lower piece. I've got these risk tolerances. Those should filter into my policies and guidance, limitations, all of my regulatory guidances here. And now I need to be able to track that with KPIs and key risk indicators that tell me when I'm not meeting this or when I'm getting close to not meeting those. You don't want to wait until after you're outside of a policy holistically. I want to know as I'm starting to trend towards something. So how do I match performance to tolerance in a way that drives insight? And again, these two areas, your top row and your bottom row, in many cases are their own dedicated swim lane with no interaction or correlation across it, unless it's maybe at that quarterly committee meeting or quarterly executive meeting where you say, okay, everybody has pulled this information and look back the last 6 months and try to put together a few PowerPoint slides and a few spreadsheet charts to try to figure out where things aren't working. This section here where you're monitoring your key risk, your predictive risk score, and extrapolating it out to look forward, is where this value and insight comes into play. I need to understand my internal view on how well we're executing to what we say we're going to do. I need to understand how well we're following that policy. I need to understand where the market and my peers are sitting at the same point in time. So how do I do this in a consistent way, and in a way really that allows me to surface the areas of concern, surface the areas of opportunity, so we can make better decisions. So we call this our optimized risk framework, but historically, this has been a little bit of a challenge. There hasn't been a lot of technology to support the people and the processes in place here. And let's be honest, spreadsheets just don't cut it. There's too much information to try to connect across these different formats of data to pull it together. So you have to have innovative technology designed specifically for being able to make these connections with really a unified risk and compliance database that connects back to your strategic initiatives. So what we're going to do here is walk through a scenario, and I'm going to turn it back over to Professor Ken. We talked a little bit about one, but we'll actually walk through and set up in a minute of what a banking scenario set of strategic objectives look like within the system. We're going to take one example for the time frame today. I know we're about the halfway mark. We actually prepared two scenarios, but recognized as we were doing our run through here that we just don't have enough time to go through both of them. We'll introduce what the other one is, but we're going to walk through just what a typical conversation might look like, filtering down from the executive level through the other parts of the organization, what some of the setup might be, and then show you an example of how that could look if it was all into one place. So with that, I'm going to turn it over to Ken and let him kind of walk us through that. And Ken, please just let me know when you're ready for me to advance to the next slide.
Yeah, no, I'm ready. Go ahead. I just wanted to point out one thing on the last piece that I forgot. I don't mean to make this all about home loans and mortgage loans, because there are always unique economic drivers for every bank market. A couple of 3 years ago, 2014, there were 200 oil rigs in North Dakota, and there were people living in tents trying to build hotels and apartments and houses. 2 years later, because oil prices crashed, there were 30 operating oil rigs and a bunch of half-finished apartment buildings. Sort of the same with farmland in various places. It goes up significantly due to development, but comes down just as quickly. So you have to be careful about how you lend into those types of situations. So in this case, we're talking about acquisition, development, and construction loans. Banks well capitalized. This is an excerpt from their risk appetite statement. They're a fairly conservative bank, willing to take some risk. They want to limit their credit losses. But they'd like to improve their earnings, so they're willing to pursue some typically higher risk categories of loans, such as commercial real estate and ADC loans, but at levels under regulatory guidelines. So the concentration limit in total for CRE is 200% versus the regulatory limit of 300. For ADC loans, right now it's 70%, but they want to push that up a little bit to say 90%. So what should they be looking at? Let's move that up a little bit. They're looking at factors like data from CoStar. And if you're not familiar with CoStar, they provide just a wealth of data on commercial buildings, warehouses, and the like, rental rates per square foot, vacancy rates, absorption rates, those kinds of things. So I'm going to show you some of those. Robert, go ahead.
Sure.
So again, their strategic goal is to increase, one of their strategic goals is to increase their ADC loans from 70% of tier 1 capital to 90% of tier 1 capital. Now, there are things you need to track, not just KRIs and KPIs. There are certain activities that have to occur, such as hiring, new development lenders, retaining the existing staff, adding some portfolio managers to support lenders. So all of those become strategic initiatives. They made some assumptions. Interest rates were going to remain steady. You've probably heard this before. We're going to remain steady, not increase more than 50 basis points. Occupancy rates were tight for Class A and B office space. So the vacancy rate was low. Occupancy rates remained high. That's a favorable condition in their view. Building permits don't indicate that there's a wealth of new construction that's going to cause overbuilding conditions in the future. So based on that type of information, they've decided that that's what they're going to do. They're going to move from or from 70 to 90, they're going to bump up 20%. So here's some things they might want to track. Robert, go ahead. First off, got to track those strategic initiatives. And unfortunately, the way we do that today is with Excel spreadsheets or kind of clunky looking Word documents that look a little bit like this. So when we give management a progress report, this is what it looks like. And sometimes it's hard to track, what's been done and what's delayed, what's late, who's responsible. So we're going to show you a better way to do this in just a few minutes, but wanted to give you an example of what they currently look like. Robert?
This may look familiar to a few of you, but yeah, having somebody update this or sharing a spreadsheet and you get a slip of the finger and now half a column is deleted.
But just the time you spend pulling all this data together. So here's some internal factors and some external data. We're obviously going to track key performance indicators. Are we actually increasing loans? How does that compare to our policy limits? What's the trend month to month or quarter to quarter? What's our loan loss reserve data? We want to make quality loans. We want to have an adequate reserve. We want to keep track of things like loan grades. We don't want to have problems occurring in our existing portfolio as we're putting on new loans. And sometimes the factors that cause those existing loans to go bad should tell us we should stop making loans like that in the future. Policy exceptions, policy exceptions tend to reflect a situation where we're taking more and more risk on. So we're granting exceptions to our normal underwriting conditions in order to make the loan. So how many policy exceptions? What types? How much of the portfolio is exposed to that type of policy exception? And then let's take a look at our risk and control environment. Okay, if you look at the guidelines the regulators published, they said you can exceed that 200, 100% guideline as long as you have good underwriting and risk management controls for credit risk. So let's track our risks and controls. Let's see what that looks like over time. But we should also look at external data, because if we're just going to look internally, we're going to miss it. It's like looking at the dash on your car all the time, right up until the time the Mack truck crosses the lane and hits you head on. So look at some of the commercial loan data. What types of loans are your peers making? How do their positions compare to yours? What's the trend line? What's the trend look like from you in comparison to your peers? Let's take a look at commercial property data of the type that we're making loans on. What's the price per square foot? What's the available space for rent? What's the net absorption rate? How much more, is there a positive absorption rate or is more space being occupied, rented than is being vacated in a particular time period, month to month or quarter to quarter? So if you got a positive trend, that's good. That means people are moving into those office buildings. There's a demand. If it's negative, that's not a good sign. So look at general business growth data, demographic data. Businesses opening, people moving into the area. All of those are good, favorable economic trends. There's a lot more data you can track. I just wanted to give you some quick examples. Okay.
This is a really good example of being able to pull a Federal Reserve economic database. And you mentioned CoStar as another one. Being able to pull out your FFIC call report data, do a little bit of analysis on it, of course, but some of that pure commercial loan data. All of these are information types that give you context to what your internal factors are telling you. If you're doing one without the other, you're not getting that whole picture. And so a lot of the purpose of today's webinar is to show you, well, how easy can it be to pull in some of this economic data, commercial property data, and demographic data? Well, if you've already got a FRED database linked into it in a KRI format that allows you to see in comparison what these areas look like, that makes your life a lot easier. You're not having to go and grab these different areas. So that's what we'll be showing here shortly that Kim was alluding to. I'll let him kind of talk through a few more of those trends, favorable, that leads us up to seeing these in different formats. And then what does it look like if I'm looking at it all in one spot together?
Yeah, I'm not going to spend a lot of time on these, but these are just charts that showed some of that data that I was mentioning to you before. So over in that upper left-hand corner, net absorption rate, you can see it's extremely positive. So, office space is being filled as quickly as it's being vacated. Space that's been vacated a long time is now being filled. So that indicates there's a demand for office space. So if you're considering making the next construction loan for an office building, you got to think about how long that trend is going to continue, because it takes a good year or so to get one of these 3-story office buildings up and ready to be occupied. But all of these are favorable trends. Vacancy rates going down, absorption rate is skyrocketing, the rental rates moving up, so plenty of income to service the debt. Okay. All right. These are the kinds of things you'd want to track on a regular basis to see, you know, is my strategic direction that I set out, is that still a valid direction to go? Does the economic data indicate to me that I'm okay, that I'm not taking on too much risk, that the environment is favorable to the type of strategy that I'm deploying? You can see here, this is what I mean by putting a number of different trend lines on the same chart. I can see where I am current period, that starts on the left-hand side at the bottom. You can see how we grew the portfolio and then we started to back off a little bit, and I'll show you why in just a second. You can see what the regulatory limit is, that straight line. So we went way above the regulatory limit. You can see what our risk appetite tolerance is. That's that sort of staggered line at the bottom. So we moved our risk appetite closer to the regulatory limit. But you can see our peers were sort of, they were not growing as quickly as we were, and they started pulling out of that market all about the same time we did. So that sort of validates our decision to start moving away from that market. Okay, Robert?
Yeah.
And this one I think is important. You know, total risk rating, that big red line, pulls in things like the risk and control rating limit, that sort of dark line at the bottom. That's where we wanted to be, but we weren't there. Our risk rating, our controls were not as effective. So what that told me was, if I'm a director, we're loosening up our controls, our underwriting standards, that green line over here on the left, just above the red line. We're loosening up our underwriting controls, or we have weaknesses in controls, and we're taking on too much risk. So we either loosen controls to take the risk, or we took the risk and we're not managing it very well. So maybe we need to back up a little bit. Let's improve our control scores. So you see those go down, and you see the volume of loans start to come back down. So we got too risky. It's pretty easy for me to see as a director why. You know, we're starting to blow up here. My financial risk rating is skyrocketing. My control rating is weak. This is just not a good place to be. So let's pull back a little bit. So these are the kinds of indicators you want to track, and this is what they will start to tell you. It's just a little difficult doing this always in Excel spreadsheets. So we're gonna show you a little better way here in just a second.
Absolutely. Okay.
And
we did prepare a second scenario. Again, I'm looking at time, and we got a little aggressive with what we thought we could do in a certain amount of time. But so as a follow-up, I know Justin mentioned this, we have another scenario that's outlined as well with similar type of data points of things you might want to be thinking out with. So rather than diving into that one, I'm actually skip over these slides, and I'm going to suggest anybody to either follow up for more details, or if one of you wants to have a deeper conversation on another specific use case, we are glad to have that conversation and show you how that might look at with your specific scenario. And so again, we recognize Ken really set it up very, very well by saying we have a few examples here because they're some of the more common ones, but it's not always going to be a particular type of loan. We recognize there's a lot of different types of organizations right here with different strategies. But at the end of the day, this is what we're seeing. You got all this data. It can sometimes feel like this. I don't know if anybody's ever felt like this, of anybody that's on this on the call today, but I mean, you've got all this data, it's all interconnected somehow, but it's really, really hard to make heads or tails of it, make sense of it, and see how it all aligns to where you're going. You know, this is, if I'm trying to map out where I'm going to go from point A to point B, where do I start? I've got all this information. I got to know where I am to know where I'm going and how to get there. And it's really difficult because you have all this information. And what exacerbates it is a lot of this information is there, but it's in a format. If any of you have seen some type of spreadsheet or board report tell us a lot of data, but it's not necessarily linked to the strategic goals and risk appetite. It doesn't have anything that stands out. I have to go pore over this, make my own assumptions, and try to figure out, what does this mean? How do I now try to understand at the end of the day what exactly decisions are going to be affected, both ones we've already made and ones we need to make? So how do I take this information and pull it back together? So kind of as again, agnostic to anything else, you know, these connections seem to be pretty tried and true on this optimized risk framework. How do I start to establish these connections? How do I set a consistent methodology within my organization? How do I make sure I'm looking at the right data to match performance and tolerance in a way that really tells me how well I'm doing? And how do I understand how this is related to peers, to external factors, so that I can understand across the board, what does all of this mean? How do we drive insight and make better decisions? The question we usually get is, okay, this sounds great. Looks fancy. It's a great image. I get how it works together, but what's feasible about this? How can I feasibly do this? How can risk and compliance technology really help me do this? Well, if you have a technology that has a singular risk and compliance database, being able to establish that baseline. A lot of you have this baseline. How are you managing your activities today in spreadsheets? You have a program in place. You're able to respond to events when they've occurred. You've got the basic check the box requirements. You have to have that in place. You have to have the people and the process in place. Where it starts to come together, though, is you start interconnecting your risk and compliance workflows to those policies and procedures, to the risk appetite statements, to all of your metrics. And when you start doing that for each one of those workflows and each one of those repositories of information that you connect together in one database, you start to be able to get a bigger picture, and you're start to be able to see trends of things before they go wrong. You're able to start to actively seek identifications of hazardous conditions because maybe you saw an uptick in complaints in one area that normally would have been siloed, but you realized that was connected to these other two areas of risk. Or maybe I saw, it wasn't a terrible exam grade, but I got a few pieces of insight where there was questions. And just having those questions or observations helped me correlate to a systemic issue that I never really had put together before. Those can start to help you proactively execute with your internal metrics. And now if I start to look at that and map that to all of my market conditions in peer analysis, I've basically put into place a dynamic SWOT analysis that is backed by data. If I look at compliance as the ability to understand how well we're executing to our policies and procedures, how well we do what we say we do. If I look at risk as how well we are hitting those guidelines to be able to hit the growth numbers that we want to hit, you have a good analysis internally looking of your strengths and weaknesses. If I can now look at that in regards to context of market conditions and peer analysis, I've got my opportunities and threats. And instead of an anecdotal approach to strategic planning, I've got business value creation. I've got the ability to look forward and provide our organization with more insight. So with that, I'm going to go ahead and show an example. Let's have some fun with this last 10 to 15 minutes here. I'm going to go ahead and pull over a live demo environment here, and I'm going to stretch it out just a little bit so we can see it here. This is a cloud-based tool. So you're seeing here the Predict360 environment. By default, I have my homepage set for my strategic objectives dashboards. If this is not rolling down from your top down, what is it helping with? Ken just said, great. You've got these spreadsheets or other areas. How can I actually understand what's going on? I have a system here set up with 4 strategic objectives. One of the ones was strategic objective 2 to grow the commercial loan portfolio. You can see other ones for growing the bank's assets, mortgage loan portfolio, ensuring bank operates in a safe and sound manner. Each one of these has its own unique identifier. It has subtasks that are related to project initiatives. I've got due dates. I've got assignees. In this case, I've got George, who is our CEO. I've got Nadia Lynn, who's our Chief Risk Officer. So you have these different assignees that let me know these are all in progress right now, and I can see which ones are crossed through because they've been completed. If I look down below, here's all of my strategic project initiatives that are tied to those unique identifier for each of the strategic objectives. So for the example we gave, objective 2, which is MRB 18, I've got my 3 project initiatives: increase number of commercial lenders, increase both retain existing staff and hire 1 new ADC lender, as well as assign a portfolio manager from credit analysis to CRA lending. I've also got to hire 2 new SBA lenders in Atlanta and Birmingham. So I've got a few project initiatives, again, each with their own owner and due date, as well as a status of each one of these. So in this case, I am seeing real-time data. If Jason comes in here and says, yeah, I just completed this, we just hired our new ADC lender, and he says this is resolved or closed, you're going to immediately see an update and a cross through up here in my strategic objective. So it's not having to go manually create or update these spreadsheets. you're seeing it with everybody working in the same system. Now the trends are on the right-hand side. I want to see my initiative timeline and status. Each one of these have some dates associated with them. I want to see what those dates are and whether they're closed, open, in progress, or resolved. And again, you notice each one of these are live links. So if I want to see all the open ones, I simply click into here and I get a list of any of these open or yellow ones that I can start to look at and work with. I can also see any overdue project initiatives. I've got 2 here for reviewing other transaction fees and reviewing loan transaction fees. These are overdue. It's nice to know that they're overdue. I can see that they're both in this space for February and March timeframe. And last but not least, who are all my strategic project initiative owner and what the status are. So I've got one nice dashboard that lets me take that strategic objectives and take a look at it throughout the entire organization. Now, you may start with this as your homepage. You may decide I want to look at something like my corporate risk profile. I see all of my areas of risks. I have here a system set up with 6 different risks. I might have 7, 10. You can determine what they are. I can see my own risk and controls here, along with the current level of risk based on either control testing or issues that may be tied to areas of risk, and predictive risk scores that may be tied to metrics that I'm tracking. So this gives me 2 ways to look at my strategic objectives, either by risk category or even by the objective category. And of course, I can come here and see some of my bookmarks. So I can see Risk Insights that pulls individual metrics. I might pull open my risk appetite statements and click into that area so that I could pull up that report. I might pull up a KRI trend dashboard. And last but not least, a top risks dashboard. All of these are visualizations that start to pull out that type of information. So I'll walk through each one of these as you saw them pull up here, and they're live loading here into this environment. This one looks, again, similar to a risk and control assessment. I've got an inherent risk and a residual risk. I can break these down into individual subcategories and risk statements, but I can tie, I've eliminated a few of these just for ease of use today. I can tie KRIs, in this case, new privately owned housing unit starts, to a data value and a target value. And right now I see this is yellow. This is outside of my tolerance level. I can see here, I've got total ADC loans that is outside of a tolerance level. I want to understand when any of these are showing me outside of my tolerance level so that I can dig in a little bit further. That's telling me I need to focus in credit risk because I got a few that are outside of expectations. So let me look at that appetite statement. I'm going to look at my credit risk appetite statement and see it's pulling up here. I've got a credit risk appetite statement here. You can see it's tied to credit risk. I've got 5 or 6 metrics here that I'm trending on, and I can see which ones are the ones that are not working correctly. It's outside of a tolerance level. 30-year fixed rate mortgage average in the United States. Here's my description. I can scroll over and see any of these outside of my middle target. Right here, I see unemployment rate in Texas is actually right in line. It's 4.3, and that's in between my 2 limits of 4 and 5. So it doesn't show up on here, but anything that's outside of my expectation, I want to see that and see how bad it is. So now I can start clicking into these individual credit risk metrics. So now I'm looking at credit risk specifically. Here's those 5 metrics. I can see which ones are in the zone. I can see a trend analysis. And if I want to look at one specifically, such as 30-year fixed mortgage rate, I can click on that and see historical data. Am I just now getting out of my target, or have I been out of my target for some time? So I can now see some target lines in comparison to the trending data. And this is data that can be pulled directly from your Federal Reserve Economic Database. It can be pulled from other data sources through APIs and set up to automatically populate here within the system. Last but not least, as I'm doing my risk and control self-assessments, I want to be able to see where are my top risks. So I can see my highest level risks, my moderately high risks as they come out. And really, where are they? Are they an operational risk, strategic risk, compliance risk? And as I break these down, can I start to see the descriptions? Where are my controls at? How many controls do I have in place for each one of these? So giving me an idea of how I want to look at this, maybe by top business units. Maybe I want to look at it by categories such as products or processes. But now I'm starting to see a breakdown of all this information in a singular format with the ability to be able to click through and look at all of my favorite reports. How do I highlight what are my top areas of risks? How do I highlight my metrics that are not acting as I expect them to, that are outside of my tolerance levels that I've defined? How am I able to look at my risk appetite statement and see where I'm outside of what we wanted to do for credit risk specifically in this example? Now, the second question we always get is, hey, this is great. How do I get this information into a system like this? So I'm going to show two quick examples. You've already seen kind of the high level reporting of what the RCSA process looks like. So I'm not going to dig into that in too much detail. But coming back to here, what I will show is both the ability to standardize on risk and process taxonomies. For those of you who are here today that are ABA members, you have access to industry best practice content libraries. So this is a wizard or a guide that allows you to build a risk taxonomy for your risk categories based on either a 360 factors community content library, and this is for all the banks that are existing customers that have opted into providing their assessments that have been anonymized or genericized. We've got an ABA content library that we've built and co-developed based on the CERP training that the ABA offers. We've got premium content upgrades from different partners of ours. These all are very easy to grab risk categories or statements and pull it over. So if I wanted to look at something like compliance risk, or maybe I'm looking at credit risk, since that was our example. Now I want to look at commercial real estate lending. I could look at any of these subsections or take the entire thing and simply move it over into my library with the click of a button. And now I can connect those to my KRIs. Simply by performing my risk and control assessments, this data is aggregated. And I can choose how we aggregate it by business unit or by product and service. So I can look at it by different views at any point in time with live data that's updated in real time. Okay. The second piece here that I'll show is the KRI section. So the last piece that I'll end with, because I know we have about 4 minutes left, and why everybody came here today. I want to set some key risk indicator definitions so I can pull this data in and link this to risks and my risk appetites. That is one of the challenges, again, in a spreadsheet. I'm going to look here at a 30-year fixed rate mortgage average in the US, because we just looked at that one. If I come over here and I edit or modify this, you're going to see the setup here. It's relatively simple and straightforward. This is coming directly from the Federal Reserve Economic Database. You can see the Fred Series ID. If I want to add one of these, I simply come in here and choose whether I want this to be a manual KRI, an automatic through API integration, or Federal Reserve Economic Database. I could also pull these in from sources like the FFIEC call reports or other data sources. I've got this series ID. I have this one connected to a specific risk appetite. So it's a metric that I have tied to that risk appetite so to really pull it all together. Here's my metric and the name. I have a description here, what this is. You can see I can tie it to my risk taxonomy. So I have it as part of my credit risk category. Down below, you see it here. I can tie it either to a category or directly to a KRI or strategic objective. So you have different ways that you can map this metric throughout the organization so that as it gets updated, it updates in all of those different reports and views that we just saw. Is this tied to corporate or a business unit? Is this going to be, a number, percentage, monetary, all standard stuff for setting it up? But the important part down below, do I have related peer metrics? Ken showed a really, really great idea of being able to connect to a few peer banks and your baseline to understand what that is. I can define all of those here. I can set my measurement period, whether it's monthly, weekly, daily, annually. And then I set my target value and then any of my triggers on both sides of the metrics. So something like liquidity or capital. If instead of having to have two KRIs of excess liquidity and insufficient liquidity or insufficient capital, what if I just had one KRI and I've got targets on both sides? So it gives you some capability to not only define the trigger levels, but also what's positive and what's negative. So there might be some areas where maybe it's less complaints than we've historically had. It's actually operating better than we expected. We've historically had 10 complaints. It may be operating a little bit better than what we wanted to. So this allows you now to pull in live data from your Federal Reserve Economic Database, from your FFIEC call reports directly into your system and tie it to risks, tie it to risk categories, risk appetite statements, and really connect with that optimal risk view across the organization. I know we've got about 1 minute left, so I'm going to flip back over to the last of the presentations. I know we're right here at time. Do we have some best practices around modernizing your risk and compliance tools while avoiding pitfalls? Absolutely. How do you put together a business case that allows you to start to change the perception of a cost center into an innovation industry driver, and really say technology can support us in ways that never has been able to do before? This one got hit on every single one of those ABA polls. Is my risk and compliance and risk appetite rolled up into the strategic and capital plan? If you need help on how to do that, reach out to us. We have some good best practices and tips on how to do that and how to make that more relevant. And then last but not least, for sure, this group may not be doing technology evaluations every single day. We've got some great buyer journey that can help you out with trying to get the investment, because this is something that can add a lot of value to your organization if it's done correctly and if you're evaluating it the right way. So here's some areas that we've typically been asked in the past. I had a question on what's the cost for 360. We typically do enterprise licensing based on the assets, the total assets of an organization, or a similar proxy, maybe the size of the organization. If it's a financial service, it could be fintech, insurance, other areas. These are very, I'll call them modular solutions. So there's one platform, but you can add any of the workflows. And then as you add more and more workflows to it, you just increase the value by that view across the organization. So for the exact cost, I can give you data ranges. It really depends on what your top priorities are, and then what the size of the organization is. We do offer that enterprise to be able to increase the collaboration there, but that's the pricing structure that we've seen be most effective here. Last piece we'll end here is with that ABA outlook. There's a couple of takeaways here, really along those lines of, excuse me a second, providing software to help the process be more efficient, which is really an ROI calculation, but then how do you start to quantify the insight and the value, the pain points that haven't been able to been solved yet. For budget, and again, going back to that pricing, this is a built for banks solution. We've got people on our staff, such as Ken, who's been working in a bank for 40 years. You're able to have workflows, content, reports that are really designed for how you're trying to make the best decisions. You've got libraries such as the ABA Risk Library for other premium libraries and community content libraries that give you a head start into not having to come up with these things yourself. So whether it's just helping support your program or really getting to help build out some of this insight, you're not having to come and put a lot of your own IT risk resources into it, because we've already built this. We only focus on banks. You look at some of the roadblocks here. Is there enough value for the investment? Is this really focused on banks? Is this something that is going to take a lot more resources from us? Nowadays, it doesn't. So this will allow you to, both from the risk and compliance perspective, invest with confidence that this could be helpful to you. So I know Justin mentioned a few of these resources earlier. We've got the Outlook. We've got the webinar recording as well as the slides. Feel free to reach out to us. We'd be more than happy to answer more specifically on pricing. Again, it's going to depend really on the size of the organization and where we see where we've been told some of the value is, as well as some of this FRED and FFIC free integration for ABA members through the April 30th timeframe. It is something that these data sources are available, and we're doing a promotion right now to be able to have that available for you for a limited time. Don't hesitate to reach out to us. We love these conversations. If you can't tell by how excited Ken and I get, this is fun for us. This is value that we see working with the bank, our banking clients. So thank you again, Ken, for joining us. Justin, thank you for the warm introduction, and as always, for being a phenomenal partner in collaborating with us. I know we only had a couple of Q&As, but we can do an individual follow-up for anything else that comes into the chat section from there. But thank you all for joining us and spending an hour of your time with us today, and we would love the opportunity to continue the conversation.
Great. Thanks, Robert.